Okay, good evening once more. Welcome all for joining the class. So in the interest of time, we'll start. Others will join us as we progress. So today we want to discuss about taxation. I know it's a topic that partly you had done in work-based, so it will not take us much of the time because we'll be revising mostly what we discussed. So we can start by recapping on a few things about taxation. Let's start by reminding ourselves why we need to deduct tax. Naomi, why do you think government need to get tax from us?
It's the government's main source of funding to generate funds or revenue.
Yeah. So tax are the main source of income for the government or source of revenue for the government. Now, there are some services that are provided by the government that if at all government was not taxing, it will be very expensive for some of us to acquire or to get them, to the extent that probably some of us will not even go for those services. For example, if government was not providing free security in terms of police officers and Kenya Defense Forces, and then some of us will not be able to access security. So in that case, government need to collect those revenues so that it can finance its operation, and of which it provides some of the services that we do enjoy. Another reason why government should collect tax from us, Pauline. As Pauline recollects, Faith, you can give us a reason. Faith Kiunga.
I didn't hear the question.
We are recapping on some of the reasons why government needed to collect taxes from us.
So that they can be able to provide basic services or amenities to the citizens.
Yes, so that they're able to provide basic service like medication. Remember, if you go, let's say, to Kenyatta National Hospital, the service that you get, the cost you'll pay is far much lower than if you went to Aga Khan. And because Kenyatta National Hospital is financed by the taxes we are charged. So in that case, if at all we were not taxed and the government did not construct Kenyatta National Hospital, most of us will still be relying on medicine from the bush. We'll be relying on herbs and all that. That's what we could be affording. We will not be able to afford those foreign or English or modern medicine. So also in schools, most public schools, primary and secondary, they don't charge a fee. So in that case, we are able to access those services. But if at all we are not being taxed, then we will not be able to access such services. Another reason, Jessica, give us another reason.
Reduce your taxable income and less revenue.
Okay, we are taxed because taxable income and revenue?
To raise revenue.
To get revenue, yes, we had discussed that. Naomi mentioned that it's a source of revenue to the government. Diana Korir, why do you think government has to tax us? Okay, who'll give us another reason before we move on to the next point, and then we do the computation and we call it a day. Who'll give us another reason? Yeah.
Wealth distribution.
Yes, for wealth distribution, and in that the best example we can give with wealth distribution is that let's say the highest paid employees in the country, they pay the highest taxes. That the higher you earn, the higher taxes you pay. But now, as much as they are paying the highest taxes, they don't exert pressure, those people don't exert pressure to the government. For example, those who are highly paid, you find that, let's say, the manager or managing director, let's say for KCB, for Safaricom, they pay the highest taxes to the government, but they don't exert much pressure to the government in terms of service provision. For instance, they don't send their children to the public schools around. So they take mostly their children to private schools. In that case, they don't exert pressure to the government. Whenever they are sick, they don't come to cure at Kenyatta National Hospital. They go to Nairobi Hospital. In that case, they are also not putting pressure to the government. For security, because they can also hire private security, they have guards, they have guns, they have dogs and all that to provide them security. So in that case, they don't exert much pressure to the government requesting for free security. So in that case, we are redistributing wealth, that we'll collect so much taxes from these rich people, but now we'll provide services that cannot be afforded by the poor. So once we have collected taxes from those rich people, we'll pay salaries to teachers who are teaching in public schools. We'll pay salaries to doctors who are working in public hospitals. We'll pay police officers who are providing security. And much of those services are enjoyed by the poor. So in that case, we do wealth redistribution. Pauline, you have not talked. You can tell us one. So because I sent notes, you read on your own other parts. So let's look at canons or principles of taxation. Canons or principles of taxation. Who can give us one canon or principle of taxation? Pauline, we can start with you because you have not talked in this class. It seems Pauline is not within. Faith, what are the principles of or canons of taxation?
I have no idea.
And you did it in CAT. What did you write?
Canon of equity.
Yes, very well. Canon of equity. That as much as government is collecting taxes, there should be some fairness as they collect taxes. That they shouldn't collect much taxes from the poor while they tax less from the rich. There should be some fairness that if they are collecting, the much they are collecting from me should be equitable to my income. So if I'm earning less amount, so I should also pay lesser taxes. If I'm earning higher amount, I should also pay higher taxes according to how I earn. So there should be some fairness in how those taxes are collected. Another canon? Naomi?
Canon of certainty.
A canon of certainty, that you should be aware, you can estimate how much you are going to pay taxes. Like for now, KRA has already started reminding people you need to file your pay as you earn tax. And it's certain you have to pay up to 30th June. You get it? So if you don't file up to 30th June, you also know the repercussion that you'll be penalized. You can file on 1st July, but now you'll have to be penalized. So it's certain. So that you don't just wake up one morning, then you are told you are supposed to pay 1 million. tomorrow you are told you are supposed to pay 500,000. The following day you are supposed to pay this much. You are only paying. Okay, we can actually ascertain how much you are going to pay and when are you going to pay that money. So it's not that there you have to guess. Am I late? Am I on time? It's clear. So KRA has set those dates. You know when you are supposed to pay, how much you are supposed to pay, so you can actually estimate and pay. Thank you. Another one? Anyone who has another point? Faith, if you have remembered, I know probably you could not have understood what we are talking about canons, but now you have understood. You can add us. Welcome, Frida. I've been waiting for you. We are discussing about canons of taxation, or they're also referred as principles of taxation. So I'm referring to those two terms because for exam purpose, you could be asked using one. You can be asked to mention canons or principles. Faith, you have unmuted, you can say.
Elasticity.
Yeah?
Principle of elasticity.
We can talk of flexibility. Yeah. We can talk of flexibility, which is closer to elasticity, that the taxes that we collect should be flexible in a way that if at all the taxpayer feels is not obligated to pay, or he feels cannot pay the way Kenya Revenue requires, then we can negotiate. You can negotiate with the Kenya Revenue Authority how you like to pay it. For example, if they give you a bill of 1 million and you don't have that cash to pay, then you can negotiate, you can engage them so that you agree on the amount, how you are going to pay that amount. You actually agree how you are going to pay in installments so that you don't crack ground your business. Another one?
Canon of productivity.
Yes, canon of productivity, that whenever we collect taxes, those taxes should, one, be used to where it's effective, where it's effective. And also, when we collect taxes, we shouldn't collect taxes to the extent that you are going to kill the business. So the way we collect taxes should be fair in that, one, we are going to need to have the business still running, and also we are going to use it for production. Just a minute, I get you display some screen here. I believe you are able to see whatever I'm displaying. So on these are the notes for taxation, and we have already looked at the purpose of taxation. We have looked at about revenue, and that government need money for the purpose of financing the operation. And then redistribution of wealth. We have talked about how we tax high from the highest earners and pay those use those money to facilitate or to finance projects or programs that can benefit the poor. Then we also use taxation for repricing, that we can, taxes can encourage us or discourage us to buy some commodities. For example, because there's more harm to take alcohol than to take milk, so the taxes on milk is very high, so that it discourages us from consuming alcohol. But now for milk, the tax is low, is even zero rated. There's no tax at all. So to encourage us to take milk, because there's benefit for taking milk compared to taking alcohol. So we can use taxation for the purpose of repricing. Then another reason is for representation, that as much as you pay little taxes to the government, but whenever there's a corruption case, you also feel that part of your money is there. They could have stolen in billions, but you only paid 2,000 or 3,000. But that 2,000 or 3,000 is giving you some representation. You feel part of your money has been stolen. So in that case, you are obliged to follow up with what government has paid, whatever case that is there. And then there are basic concepts about taxation. So when you talk of taxation, there are some terminologies that are used. For example, we have the previous year, and this is the financial year for which income is assessed. And I've given an example that today or currently Kenya Revenue Authority has started reminding taxpayers to file the pay as you earn. Now, as we are being reminded, we are being reminded to file pay as you earn for 2020. So that's what we are referring to, the previous year. So, and then number 2, we have assessment year. Now, assessment year for that case becomes this year. For 2020, taxes for 2020, which was the previous year, the assessment year becomes 2021. So taxes for 2021, we'll assess them in 2022. So 2020 will be the assessment year. Then tax base, and this is a measure or value upon which tax is levied. That as we look at that when we do the computation, the tax base, how we count, how we do the much we can calculate for taxation. And then we have a proportional tax. Now, when you talk of proportional tax, that we are charging you tax according to your income. For example, pay as you earn. The more you earn, the more taxes you pay. Then you have a progressive tax, and these are tax whose burden is expressed as a percentage of income, increases as income increases. That the same way, the way we can compute the income tax, pay as you earn, the more you are taxing your income increase, the more the percentage also increased on whatever we are going to deduct you. Then we have regressive tax. It's a tax whose burden expressed as a percentage of income falls as income increases. Now, yes, with the income tax, if you are a low income earner, we'll use progression tax. But if you're a high income earner, then it will get a point where we'll get regression tax. How it's applied. That if you are, sorry, if you are earning certain amount of money from the, okay, if you are earning, let's say, up to 500,000, then your taxes keep on increasing. But if you have to get a promotion and you'll get an additional of 600,000, then we have to start now declining that tax, so that we also encourage those people people to seek those higher positions. That we don't overburden you with the taxes just because you have been promoted or you are earning more. So in that case, your income tax, the way it's treated, the higher you go, the taxes increases, but it reaches a certain point where now it starts going again down. So when it starts going down, then we refer to it as a regressive tax. Then we have excise tax. It's tax on specific commodities. Okay, specifically for excise tax, for instance, if you import, like if you import rice, you bring it into the country, then you have to repackage into smaller packets. By the time you are importing, you will pay import duties. But now, if you are repackaging into smaller packets so that it can be bought or it can go to the market, then you'll also pay another tax, which is an excise tax, because you are doing a value addition to those commodities. You are making them buyable, or you are increasing the demand for those commodities. And then we have average tax rate, as we shall compute. We'll do that in computation, and we'll see how we arrive on average tax rate. So that, for example, in income tax, the amount of money you are being deducted is deducted on percentages. There's different percentages. Now we shall compute how those different percentages, different amounts. Then eventually we shall also compute the average tax that you are going to pay. Then the marginal tax rate, and this is the rate you pay on any additional income you earn. For example, I've given you an example that if you are employed and you have increased your income from 500,000 to 600,000, now that increase of 100,000 will also result into an increase in taxes. So now, once that increase in taxes has been accounted for, that increase in tax is what we are referring to as marginal tax. That tax has increased just because your income has increased. Then we can look at the classification of taxation. We have direct tax, and this is a tax whose burden is borne by the person on whom it's levied. For example, pay as you earn, that it's your personal responsibility to file your pay as you earn. So if you don't file your pay as you earn, you cannot refer KRA to your employer. If at all your employer deducted you and did not pay, but for you filed your pay as you earn, in that case you disclosed that you are deducted. So you acknowledge that you have been deducted. So in that case, the KRA will attach the employer. But if you did not file just because you have had your employer does not remit money or does not remit to KRA, then the burden is on you. So that means that you'll be surcharged or penalized as an individual. Now we have indirect taxes, and indirect taxes are taxes of those paid by consumer when they buy goods. That if you go today to the supermarket to buy sugar and you pay 220 or 230 shillings per 2 kg packet, not all those monies are meant for the sugar. 16% of those money belongs to the government as a VAT, value added tax. So now such kind of tax is what you are referring as indirect tax. So I'll skip on tax structure in Kenya. Let me define these three terms: tax avoidance, tax evasion, and tax planning. So now when you talk of tax evasion, this is reducing tax liability by deliberately manipulating income or expenditure, and it's illegal. To do tax evasion, it's illegal. And this is done by manipulating income. For example, if you go to Luduli Avenue, you want to buy an electronic. So they will tell you, if we give you an ETR receipt, we'll charge you, let's say you are buying a TV, 32-inch TV. So they'll tell you, if we give you an ETR receipt, we'll charge you 15,000. But if we give you a manual receipt, we'll charge you 12,000. or 13,000, we'll give you a discount of 2,000, so we'll charge you 13,000. So in that case, if at all you agree to buy and get a manual receipt and pay 13,000 to save 2,000, then you have deliberately manipulated your expense. Just a minute, please. I'll say that if you agree to get the manual receipt, because now with the manual receipt, they will manipulate so that they indicate, probably they will record later on that they only sold a 21-inch TV and they sold at 7,000. So in that case, they are manipulating that income so that they also reduce the taxes this. So if you do that, you'll be doing tax evasion, and that is illegal. If you are found, you'll be penalized. And then tax avoidance. This is taking full advantage of loopholes to attract least incidence of tax. For example, if you go to supermarket, you'll find they are selling vegetables. You go to Marikiti, you'll also find they are selling vegetables. But now, if you go to Marikiti, they will not charge you VAT. If you go to the supermarket, they'll charge you VAT. Anything that is sold in the supermarket will charge you VAT. So in that case, if you go and buy vegetables from Marikiti, then you'll have avoided the tax, and it's legal. For that purpose, it's legal. It's allowed. Or you can also decide, rather than buying vegetables, you can have kitchen garden and grow your own vegetables. So in that case, you are growing that vegetable so that you don't have to go and buy from the market to pay taxes. So that's also allowed. Within the law, it's allowed. Then tax planning. This is making use of all beneficial provisions mentioned in the law. That you can plan how much taxes you are going to pay, and as per how the law provides what you are supposed to pay. And probably most businesses have been using this advantage, and that's why government is following up to introduce minimum tax. Because if at all you have a business and it makes loss, then you don't pay taxes. You cannot pay taxes if you have made loss. You'll only remit if you had withholding tax, or you had VAT that you had collected on behalf of the government. But now you will not pay an income tax, which you for the income you had, because you did not make profit. Now, because most businesses were using that loophole, so they will do business for the whole year, manipulate or adjust their expenditures, so they realize that you have made a loss. So after that, you don't have to pay your own taxes. So that's why government is following up to introduce minimum tax, so that you have to pay tax at any given point. So we have tax crime. You can read through them. Tax crime, you can read through them. Now we look at the computation of tax. Now, when you talk of computation of tax, for other taxes, they are straightforward. If we talk of VAT, it's standard. It's either 15%, 16% for most commodities. There's 8% for fuel. There's 0% for maize flour and milk. There's about 14% for some commodities. Now, it's a percentage of whatever you buy. So if you go to a supermarket and buy items for 10,000, then 16% of that amount is VAT. So we'll not go into details computing that. We'll also not go into detail computing other forms of taxes, because it's only a percentage of the volume. So if you are importing a motor vehicle, for example, you'll pay import duty about 3% or 5%. So if you import a motor vehicle you have bought from UK or Japan or German, wherever you have bought the motor vehicle, you have bought it at 3 million, 5% of that amount you'll pay in terms of import duty, and other taxes that you need to pay. So the tax that we'll do the computation for is pay as you earn. So because we are doing project management, there's also tax exemption. I will expect you to read that on your own. Let me scroll and see any question. Okay. Maybe we can discuss this because you are not able to mention a number of them. The principles or canons of taxation. So a canon of taxation, one of it we have discussed about canon of equality, that we should be fair the way we charge taxes so that we don't overburden one section. We don't overburden the rich to benefit the poor. We also don't overburden the poor to benefit the rich. There are some instances where the rich are taxed more. There are some instances where the poor is taxed more. For example, if at all if at all you are poor, let's say you are working and you only earn about 300 shillings per day. You know, much of that money you pay to the government in terms of taxes. A higher percentage of that is paid to government in terms of taxes compared to somebody who is earning a salary of 100,000. And this is how it may happen, that you get the 300 shillings. For you to prepare a meal, you'll have to go and buy paraffin. Paraffin, you'll pay higher taxes in terms of VAT, and somebody who is earning 100,000 may not be using paraffin in his house. He is using a cooking gas. So cooking gas is zero rated. So if we are to prepare a meal, I'm preparing a meal using fuel that is zero rated. I'm not paying any taxes to the government. But for you, because you are poor, you are preparing a meal using fuel that you'll pay taxes to the government. So a canon of equity or equality, it says that when we are taxing, we should consider those parameters so that we don't overburden either the poor at the expense of the rich, or we don't overburden the rich at the expense of the poor. Then we also have a canon of certainty, that it should be clear when are we supposed to pay taxes, on which date, how much money are we supposed to pay taxes, so that Kenya Revenue does not just come up and say you are supposed to pay now 10 million. How does a business get that money immediately? Or Kenya Revenue does not just come and say you need now to pay this much for this particular period. So they should spread out and tell you this is the much you are supposed to pay and this is how you are supposed to pay, so that you can compute and say this is actually what Kenya Revenue is entitled to get. Then we have a canon of convenience, that the way we pay taxes, Kenya Revenue Authority should create a convenient way that you can pay. For example, nowadays, every bank, you can pay taxes through any bank. You go to any bank, they have an account for Kenya Revenue Authority, or they can collect money on behalf of Kenya Revenue Authority. You can also pay through M-Pesa, you can pay through Airtel Money. So they are creating those avenues just for convenience. And again, they're also providing you that if you are supposed to pay taxes, once you have declared the much you are supposed to pay, they give you a period of 30 days. So that if you have declared today you are supposed to pay taxes and you don't have that cash to pay, you can look for it. Or if you have to pay today, you have declared today, and you go to a bank and you find there's a long queue, you cannot queue because you have other operational activity, then they have allowed you for 30 days for you to pay those taxes. In that case, they're creating convenience. And then you have the canon of economy. Now, with the canon of economy, I look at it that if at all, let's say somebody, okay, I operate a small business, let's say in Dandora. So if I'm operating a small business in Dandora, and we have to get officers from Kenya Revenue all the way from Times Tower coming to Dandora to just follow up. And whatever they are going to follow up, the much I can pay in terms of taxes is about 500 or 1,000. And for them to come from office coming to Dandora, it will cost them a taxi about 2,000 to come to Dandora and 2,000 to go away back to office. So in that case, they will spend more money than what they are coming to collect from me. So the canon of economy stipulates that if at all they have to leave office to come and collect those taxes, then they should be coming to collect a lot of money that can take care of the cost, the operation cost that they have incurred, and also generate a surplus to the business or to the government. So tax canon of economy states that we should, when we are collecting taxes, we should be in consideration how much money are we going to spend for us to go and collect this much. And that's why with this canon of economy, for small businesses, Kenya Revenue Authority got into partnership with the county government that when you are paying your license, trade license, because there's already laid out procedure how the county government will collect those licenses from those businesses, you pay 15% of that amount as taxes, so that they don't have to bother you computing, because those small businesses, they don't have records. So even if they were to leave from office to come and assess, there's no record that they can rely on. You go to a saloon, once a lady has been plated, they pay money, it doesn't require a receipt. You go to a barber shop, once your hair has been done, you don't require to be given a receipt. You pay and leave. So there's no record that Kenya Revenue Authority can come and rely on and say, now this is the much you can pay. So considering the canon of economy, they just tell you this, the pays 15% of the license. Either you make more or you make less, we can forfeit that. Then another one, we have canon of productivity. And so now, with the canon of productivity, we say that the amount of money collected, that the tax should be productive in the sense that it should bring large revenue, which should be adequate for government. That as we collect money, and then we should be able to collect a lot of money that can finance the government, that she's able to finance the operation of the government, so that government can function. So we shouldn't collect so little money, or we shouldn't exploit our citizen. Then we also have canon of elasticity, and it's closely related to productivity. And this canon of elasticity requires that government should be able to raise the rates of taxes when it's in need of more revenue. So like beginning January, okay, for sometimes last year, previously there were no VAT tax on fuel, but from last year the government introduced VAT on fuel. From this year up to this year, we didn't have minimum tax. Now government has introduced minimum tax, so in that case they're exploiting the canon of elasticity. They're increasing those rates so that they're able to collect. So government can also vary the interest rate, the charges, how much does a company pay as a tax, or how much does an individual pay as tax. So they can vary those rates so that they collect more money or be able to function. Then you also have tax canon of flexibility, and flexibility means that there should be no rigidity in taxation. So as the government collects taxes from the citizen, there are no rigid rules. They are flexible. That if at all I'm supposed to pay 100,000 to the government today, and I don't have, but I've not declined to pay, but I can't raise that 100,000 today, then government cannot sue me or cannot take me that I've declined to pay that. We can get into agreement how I'm able to pay that 100,000 in a reasonable way, so that I clear that much and also be able to pay for my operational cost. Then we have canon of simplicity, that the tax system should be simple, plain and intelligible to the common taxpayer. Now, for those who have been in the country for a while, there's a time to file returns, you are filling physical forms. You get that form, when you start filling, the only thing you can write on that form is just name. It was very complicated, very complex to fill in. So it was very complex. So from the forms until, okay, it was complex until it reached a point where government or KRA was just insisting, as long as you get a form, you write your full names and ID number, you attach your P9, then the rest, they get clerks to fill in those forms on your behalf. It moved from that particular point to now the point where you fill in online. So first time they introduced online, it was also very complex. You get a very huge Excel sheet asking you a number of questions that some of them are not even applicable. So, and they've kept on simplifying that system until now, when you file, you find it's very simple that you can easily do it. So we are saying that the system of the Kenya Revenue Authority should not be very complex to scare away the taxpayers. It should be as simple as possible so that we are able to use it. Then we also have canon of diversity, that a single or few taxes would neither meet the revenue requirement of the state nor satisfy the canon of equity. There should be therefore a variety of taxes too, so that all citizens should contribute towards the state. Yes, that if at all government was relying just on a pay as you earn, that amount of money will not be adequate to finance the operation of the government. Or if the government was to rely on a VAT, value added tax, then that tax will not be adequate to take care of the operation of the government. So in that case, government has to come up with the different taxes. How do we tax farmers, for example? How do we tax juakali? How do we tax mama mboga? How do we tax the businessmen? How do we tax the corporation? How do we tax the employed persons? So now when you have all those variety of taxes, then we are applying the canon of diversity so that we are able to collect as much money as possible. So we have on here factors that determine taxable capacity. You can go through it. That's simple. Mm. Let me now get a question. We do computation for income tax, and then we call it a day. So maybe before we do the computation, anyone who can ask whatever we have discussed for the last 1 hour? Anyone with a question or a concern? And you did this question on for work-based? Yes, you did under work-based, and the same question that you want to solve so that we can tell how you are to go about it. Can I presume that all of you have the question? Or can I allow you to note it down? Faith, do you have that question? Naomi, do you have that question?
Will you allow us to note it down?
Okay. Take the shortest time possible. Once you are done, you can let me know. Are you done? Confirm if you are done. Faith is done. What is done? Frida is done. Who else? Only Faith and Frida are done. Naomi, are you done? Naomi is done. Jessica, are you done?
Yes,
Pauline?
I'm done.
Okay, Pauline? Pauline, are you done? Pauline is engaged, not talking to us today. So now we'll do computation. So the first question is asking us to compute the gross pay. So now for us to compute gross pay, pick a pen. Gross pay is equals basic pay plus allowances. Allowance. So let's look at the question and see the gross pay or basic pay. So in this case, he had a basic pay of 70,000. So that means we'll do 70,000 plus allowances that he earned. He has allowance. He has hardship allowance of 15,000, commuter allowance 7,000 plus 15K. Write in full for the sake of your revision. Plus 7K. Plus house allowance plus entertainment allowance of 20,000 each. So plus 20K. 20K. Plus another 20K. What's the answer? What's the answer to that?
And 32,000.
You said 132,000. 132,000. So that's the gross pay. We go taxable income. Number 2 is taxable income. So number 1 was as simple as that. Just adding those values. Can see if you didn't get correct, you can see how simple it was. Taxable income. Taxable income. So we don't tax taxable income. This is equals gross pay minus pension contribution, pension and pension. So you can place this in bracket because there are several figures, and life insurance. So usually we don't tax pension. A government does not tax you or amount of money you are contributing for pension, and they also don't tax you amount of money you are contributing for life insurance. And probably the rationale or the reason why government will not tax you on such money is because when you are contributing towards pension, you are contributing towards life insurance, there's a liability you are also relieving the government. Because let's say, like most of us, our age, we don't frequently, if I ask you how or when did you last visit hospital, you probably, some of you have taken a year or 2 years, you have never been to hospital. Even if you are in hospital, you are treated of basic malaria, the simple ailments that doesn't cost much. But now as you age, as we grow, then some of our immune system goes down, so we frequent hospitals, we can't see, we can't hear, all those, we always feeling fatigue and all that. So that means if we go to hospital, we find most elderly are the ones frequenting those hospitals. So government do encourage you, then they don't tax you on the amount of money you are paying for pension or amount of money you are paying for life insurance, because they know such monies will assist you when you become old, so that you don't have to rely to be asking government nisaidie hapa. So our gross pay in this case is 132K, 132,000. Then we'll minus, let's look if we have pension. Did we have pension?
Yes, 6,000.
6,000.
And life insurance?
3,000.
Yeah, so 6,000 plus 3,000. Who was the answer? You can tell us.
123,000.
123,000. So that's the taxable amount. That's the taxable amount. It was as simple as that. Are you enjoying? And then we go to gross tax. Gross tax. Gross. Now, for us to compute gross tax, we'll now apply the tax brackets that are applicable. And this is how we do apply. Because we have computed already the taxable amount is 123,000. So in that case, this person, we don't say, because he's in need, that 123,000 is above 57,334, then you apply 25%. Some of you applied directly 25%. That's very wrong. And that's over taxing that particular client, that particular citizen. So this is how government do compute taxes. That up from 0 shillings up to 24,000, he'll pay 10%. So in that case, we'll do the first bracket. We'll have 24,000 times 10%. If you have the answer, you tell me.
$2,400.
2,400. Then you go to the second bracket. Because he surpasses is still above that second bracket, so we only get the interval. So we'll do 40,667 minus 24,001 shilling. We subtract the upper limit from the lower limit. So the upper limit is 40,667 minus 24,001.
$16,666.
So you said 16,666. 6. So this is tier 2. So we'll apply the percentage that's there, 15%. So we'll pay this at 15%. multiply by 15 over 100. If you get the answer, you let me know.
$2,499.9.
2,499.9.
Yes.
0.9. Then we go to the third one. The third one, we are doing 57,334 minus 40,668. What did you get?
$16,666.
16, 6, 6, 6. Now we'll apply the third module is 20%. 20% of that. What's the answer?
$3,333.2.
You said 3,333?
300.2.
Triple 3 mara 4.2.
Yes.
Hivyo. We go to number 4. Now, number 4, because that's the last bracket, and you have been told any amount above that, we pay 25%. So we do our taxable income, which was 123,000 minus 123,000 minus 57,334. $123,000 minus 57,334. How much do you get?
65,666.
65,666.
Yes.
Now we subject this to 25%. How much do you get?
$16,416.5.
16,416.5.
5. Yes.
Yeah. So now we add these amounts. Add those amounts from 2,400. Add all through. What's the answer?
24,649.6.
You said 24,600. and 49.6. So now this amount is what we refer as what we were asked to get, which is gross tax. So net tax payable. Next is net tax payable. Tax payable. So for us to get the net tax payable, this equals gross tax minus tax relief. So gross tax we have computed is 24,649.6. 24,649.6 minus, how much is tax relief? From that question, how much is tax relief?
2,400.
2,400. So minus 2,400. How much do you get?
22,249.6.
I've not, yes, I mean 22,000.
22,249.6.
249.6. So that's what you are to get. And then we have computed the next net tax payable, net pay. So we compute net pay. So net pay is equals gross pay minus, or rather that minus is below before the bracket, minus tax, net tax plus other deductions. Close the bracket. So we look at the gross pay was 123, 132,000. We'll have 132,000. Now minus net tax. We have computed net tax is 22,249.6 minus, plus. We add, remember there was a deduction for insurance, life insurance, about 3,000. And there's also another one for 6,000. How much do you get?
$100,750.4.
100,000 750.4.
Yeah.
So this is the match that will go to his account. Then the last question was average tax rate. Now, for us to get average tax rate, average tax rate. So this is equal net tax over gross income, gross pay over gross pay times 100. So net tax we had 22,249.6. 22,249.6 divided by our gross pay was 132,000. 132,000 times 100. If you have the answer, you tell me.
$16.856.
16.856%. So that's the average tax rate that this particular employee was being charged. Though we have computed with the different percent, different percentage, but that's now the average. Averagely, that's the percentage he pays as tax. Any question pertaining to taxation? Any question pertaining to taxation? Naomi?
No.
You have no question? You are contented?
Yeah.
Okay. Frida? Frida? Frida,
Yeah, I'm good. Thank you.
Okay. Oh, I was thinking if you had joined Pauline. No, Pauline deserted us, or Pauline is back? Pauline,
Yeah, I'm back.
you deserted us along the way. Have you made supper for us?
Yeah.
So we are coming, eh?
So,
Coffee is not an issue for us. We'll just come for supper.
okay.
Hey, Jessica. Yeah, we are coming for supper. So you had gone to make supper.
Understood.
Hey, Jessica. Understood. Faith?
I'm good. Although I had a debate with a friend of mine who was telling me that allowances are not taxable, but apparently they are.
Allowances are taxable. There are some fringe benefits which are not taxable, but allowances are taxable.
All right.
Yeah. So there are some fringe benefit, for example, per diem. If at all, let's say, if at all you have to go and work outside your office, there are some allowances you are being given for you to be outside your office or outside. For example, you are working in Nairobi, you have been sent to Mombasa, you have been sent to Nakuru, that's outside your area of operation. So they'll pay you something with fast per diem, or you have been sent outside the country. So you'll be paid something called per diem. So such amount of money is what is not taxable because we are giving you this money to facilitate. You are not used to that particular environment anyway. So we are giving you this much so that you are able to stay as you or to work within that particular environment. For instance, if we have taken you to a hotel, or even if you have rented a premise or a place and you have sent you to a town that is you are not familiar, you don't know where to get the best bargains. So we have to, your expenses will automatically be high. For instance, have you ever tried, just try one day, go to Ambassador and ask either border that you wanted to go to Kencom. It's across the road, but if you ask them, they'll charge you 200 shillings. Then they'll take you all around town, and then you'll realize they have just crossed the road. You get it? Just because you are new or you are not familiar with that, so there are those instances that will happen. But because you are within Nairobi, such things cannot happen. If you want to go, you can just ask for direction, or if you don't know. But now it's something where you can walk. Yeah. So it's only per diem that we may not tax, but other allowances are taxable. Another concern?
How about a bonus? If you're given a bonus, is that
if you are
taxable?
given a bonus, it's also taxable.
Okay.
Yeah. Though the organization also treats bonus in different way. Sometimes they give in terms of shopping voucher. Now, if an organization is giving you a bonus in terms of shopping voucher, then it means that organization is not going to record that as part of your payment. It's going to record that as its expenses so that it reduces on its taxes. So, for example, I work with the Kenya Institute of Management. Kenya Institute of Management has made a profit of 10 million. Now, with this 10 million, they have to pay, let's say, 30% to the government. Now, if they pay 30% to the government, that's about 3 million. There's no incentive, there's nothing that they'll be motivated by paying that. But now, Kenya Institute of Management can decide and say, for us to motivate our employees, we have 50 employees. We want to buy every employee a shopping voucher of 250, or every employee a shopping voucher of, let's say, 10,000. So if we are 50, that means it's 500,000. Now, as they are paying that 500,000, it will reduce the income. Now, they will not declare a profit of 10 million. They will declare a profit of 9.5 million. So in that case, they will pay lesser taxes. But as they pay lesser taxes, because they have given me an incentive, a bonus of 10,000, I'll feel motivated. Tomorrow I'll become very jovial and energized to work. Get it? So sometimes organizations do use those loopholes, and that's what we are referring as a tax planning. You use the loopholes that are within the law so that you capitalize on you capitalize on taxation. So if the company has done tax planning, so they will not pay you in terms of cash. They'll give you a shopping voucher. So in that case, they'll treat as an expense to the company. Any other person with a concern? Jessica, you have not asked a question. Pauline, you have not asked a question, and I'm concerned. Frida, you have not asked a question, and I'm concerned. Naomi, you have not asked a question, and I'm concerned. So if there's no other question, because Pauline, you have missed part of the meeting, though I have recorded, I will upload I'll upload and send you the link so that you can assess. For those who missed, I know a number of you have not attended the class. Last week we were about 12, today we are about 6. So that means a number of us have not attended. So I'll send you the link for those who like to use it for revision. So Pauline, because you deserted us for a while, you can now lead us in a word of prayer, then we go take supper. You also remember to pray for the food you have prepared as we come for supper.
Okay.
Yeah.
Well, let's pray. Our God and our Father, we are so grateful this afternoon for your mercies and your grace upon our lives. We say thank you for the class, oh God, as we depart, oh God, to our various activities, oh God. We pray that you be with us tonight. We commit the night unto your able hands, oh God, that God will watch over us, oh God, watch over our friends and our families whenever they are. We pray for the food tonight, oh God, the supper that we've prepared. Bless it before we take it. In Jesus' name we do pray, trusting and believing. Amen.
Amen. Okay, thank you. I wish you all the best. Let's meet for Saturday. Let's meet on Saturday. For evening, let's meet next week, our usual time. Have a wonderful evening, a wonderful week.
You too. Thank you.
Thanks, you too.
Welcome.
You too.
Thank you.